Welcome to the CLS Monthly Market Review. I'm Rusty Vanneman, President and Chief Investment Officer at CLS Investments, and with me this month is Case Eichenberger, Senior Portfolio Manager.
Hey, Rusty.
Welcome, Case.
Thank you. Thank you.
Well, August was basically, as advertised, a pretty volatile and exciting month.
Right.
What were some of the highlights or lowlights?
Yeah, so some of the highlights, kind of reading back some of the reviews, I think when we were talking earlier, there was 3 separate occasions when the market was down. U.S. market was down 2.5% on a single day. So very volatile up and down. So overall, the U.S. market and global markets were negative. U.S. stocks down about 1.5, global stocks down a little bit worse, over 2. But some of those diversifying asset classes like REITs, bonds, gold, which we talk about sometimes, were actually positive for the month. Gold up about 8, bonds up about 3, and REITs up in the 3% range too.
Those are great returns.
So diversifiers, kind of helped you definitely from a stock drawdown. But overall, still pretty
Long Treasury bonds are up over 11%.
Right. Yeah.
Yield, well, the 10-year yield dropped from 2% to 1.5%.
Exactly.
But you know what? As you know, you talk to investors and advisors all the time. There was quite a bit of nervousness out there. But quite frankly, August was pretty normal for an August.
Right. Yeah.
And we probably should expect the same in September. September typically is the same sort of thing.
Yeah, which kind of brings us to, I guess, some of the commentary you're writing about, which was the questions and answers, kind of some quick Q&A.
You like that format?
Yeah, what is it, about 15 questions or something? It is nice format because it's a lot, I think, what investors are thinking, and they want to know just quick bite-sized answers of what our investment committee, our investment firm is thinking. So,
did you have some favorite questions?
I did, yeah. I wanted to ask you a little bit about, well, I guess you mentioned interest rates, so at 1.5% or so on the 10-year, where do you think we go, higher or lower from here?
Phenomenal question, because it is the top question right now. So I think, again, 10 years are at 1.5%. I think they're going to go back to 2 before they are 1. The argument for going to 1, however, is that there is strong momentum and global yields in general are still lower. But you know what? The economic data doesn't support it. And the way the Federal Reserve governors are talking, it doesn't seem to necessarily support an aggressive Federal Reserve cutting rates. Sentiment is so bullish for the bond market right now that usually as contrarians, you would suggest that interest rates will go back higher. I think that was a longer answer than what I wrote in the commentary.
Yeah, you did mention the sentiment, but I'm glad you went that way because it is definitely bullish right now for bonds, but very bearish for stocks. So usually it is a contrarian indicator, which we definitely look at here when looking at short-termism. So I guess leading into that, though, yield curve is inverted or has been in and out of inversion, which would expect maybe more cuts, or what are your thoughts around the yield curve and where that goes with the economy?
You're right, that's another big question we're getting right now. The yield curve, when it inverts, that means the long-term rates are lower than the short-term rates, which is very exceptional because, of course, as an investor, you usually require a higher interest rate holding something for longer.
Right.
So it's exceptional, and generally it means that expectations that growth will be lower. And quite frankly, I think even though there are nuances to it that suggest it might be a little different, it's still a storm cloud on the horizon that bears watching that does suggest, I think, that we're going to see below average economic growth down the road.
Right.
Not necessarily tomorrow, but it is a signal, and it's something to watch.
So I got 2 more maybe if we still have time. I guess quickly into tariffs. Kind of dovetailing on economic growth, tariffs, does that just take us to recession with the yield curve, or what are your thoughts on China-U.S. relationship?
Well, I sort of debate, is it really a trade war? And I say war in the sense that, is the impact meaningful enough to really call it a war? Is it still just a skirmish? Obviously, it's causing a lot of short-term volatility. For long-term investors, it still qualifies as noise. Again, it's a storm cloud. It needs to be watched. I think probably the impact on the markets and the economy at this point is maybe a little overrated. I think actually one thing that's really fascinating, do you know the 2 top performing stock markets in the world this year are the U.S. and China?
I was just looking at that before, and obviously we knew the U.S. Well, I think a lot of us did. But China, up what? I mean, over 10%.
Yeah, right? I mean, they're having great years, and those are the 2 economies supposedly most impacted by this. So it's always interesting how that happens.
That was surprising for me to see. A shares, which are the China mainland share classes that are just coming on board into indexes right now, are I think up over 15%. So kind of surprising how that's working out. And then lastly, going kind of back to the yield curve, we've seen some research talking about value stocks kind of do better. Do you have any thoughts on just value stocks here in general?
Well, a common question is, because value's underperformed for so long, what could be a potential catalyst for it to turn around? And I think there are two that stand out. One, which is I think more attractive to everybody, and one that's probably not as attractive. And the first one would be simply if sort of the U.S. large cap tech stocks, such as the FANG stocks and what else, if they just got crushed or just significantly underperformed. They've actually been underperforming for a while, but if that happens, that could bring down the market. And then value will probably outperform like it did in the fourth quarter of last year.
Right.
That is not, that could very well happen, and we've seen that happen before. I think what's going to happen more likely, and what I kind of hope, I guess, is that we're going to see inflation expectations and inflation and interest rates start to move a little bit higher. Not necessarily freak out, but just move higher. And when that is the case, usually value outperforms.
Right.
And given it has such incredible valuation support, you get that sort of backdrop. You could see value stocks do very well, while the rest of the market is probably still doing okay, middling. But that would be a more attractive situation, and it's very plausible.
Definitely. So I guess lastly, in your commentary, you talked a very a good statement around value investing legend Warren Buffett, kind of talking about the value stocks, how they've been out of favor, and Warren just had a birthday here recently. Omaha native, 89 years old, I think, which is just amazing to me that he's still
He's got another 20 years there.
I think so. If you go to the shareholder meetings and you watch him and listen to him and read his writings, which we all do, he's still epic out there. So how did you talk about Warren in this commentary?
You know what? That was one of my favorite segments I've written in a while.
Yeah.
I mean, if I liked it, it probably means it wasn't that great. But anyway, I liked it. Well, the thing that's fascinating about Berkshire Hathaway, which is, of course, the company that Warren Buffett runs, is I think first of all, Warren Buffett is so important on us as investors here in Omaha. I mean, we're all influenced, whether we're directly saying he's influencing us or indirectly. And the way we invest money at CLS, I'm not saying it's like Warren Buffett, but obviously it's been influenced by him. And we obviously have a value approach. A couple things about Berkshire Hathaway. He's underperformed of late in all time frames, as you would expect. He's got the value tilts. But a couple of things that really stand out. Well, first of all, he doesn't have the international exposure like we have. He's really domestic only. So how's he underperformed? I mean, he has underperformed this year. So the market is up big on the year still. And he's actually, at the end of last month, Berkshire Hathaway is negative.
That's amazing, right?
Isn't that nuts?
Yeah, it's nuts.
And a couple reasons for it. One, he has an incredible amount of his portfolio in cash right now. And a lot of people are demanding that he needs to invest it and buy back the stock, which he will do, but he hasn't. So why hasn't he done that? Now, he hasn't come out and said it, so here I am guessing why. But his favorite indicator is looking at the size of the stock market relative to the size of the economy.
GDP.
And right now it's at all-time highs, which would suggest the U.S. market is very expensive.
Exactly.
So is he waiting for a correction, or is it just indirectly he just can't find anything to buy, which is probably more the case. So that would suggest the U.S. market is expensive. And I would like to think that means that international stocks are more attractive.
Yeah, relatively speaking, they are. We know that by PEs, price to books, things like that, right?
Exactly.
Dividends.
And then the second thing is, granted Berkshire Hathaway is already a financial stock, but then again, he can go out and buy anything. He has diversified his revenue streams, but 8 of his top 12 holdings are financials, and almost 50% of his stock holdings are financials. Financials have been getting killed. And it makes sense because the yield curve is inverted and all these other reasons why financials would not perform. But he's a long-term investor. And as Chris Davis from the Davis Funds, a big holder for us as well.
Legendary investor,
He's recently said that the financial stocks are the most attractive they've been since the late 40s. Now we're talking about once in a generation opportunity for international versus domestic, value versus growth, maybe even small caps versus large caps. But this is financials like once in a lifetime opportunity. So anyway, that would suggest that if Warren is ultimately right, like he usually is, then financials and value should outperform significantly sometime in the year or years ahead. So those are the takeaways.
Which we expect, and it definitely just have to stay disciplined to your investment philosophy. Never want to change it. So I agree with you there.
I loved your questions.
Thanks, Case. Good answers.
Well, thank you for your time and trust in CLS Investments, and we will see you next month.